There's no breaking news today, no emergency Fed meeting, no stock market crash, no headline screaming crisis. And yet, global money is quietly changing direction, not next year, not sometime in the future, right now. And the strange part is this: markets are already behaving as if something fundamental has shifted, even though almost no one is saying it out loud. Most people believe money only moves when something breaks. A bank fails, a government defaults, a war starts, a market crashes. That's the story we're used to. Something explodes, and then money reacts. But that story is comforting, because it implies we'll see it coming. It suggests there will be a moment where everyone agrees, okay, now things are different. That moment almost never comes, because real capital doesn't wait for permission to move. Here's the uncomfortable truth. When you notice panic, when headlines turn red, when everyone starts asking the same question at the same time, the most important decisions have already been made. Money that moves in panic is not powerful money. It's late money. Think about who actually controls large pools of capital. Not traders refreshing charts, not retail investors, not people reacting to Twitter. We're talking about pension funds managing obligations decades into the future. Central banks whose job is to avoid surprises. Sovereign funds that care more about survival than return. Institutions that don't need to explain themselves publicly. These players don't move because something happened. They move because something stopped being reliable, and reliability doesn't disappear overnight. It erodes, quietly. That's why what's happening right now feels strange. There's no shock, but there's also no confidence. Markets are still functioning, but they're behaving defensively, like drivers slowing down not because they see an accident, but because the road ahead suddenly feels unfamiliar. Look at the contradiction. Interest rates are high, yet long-term confidence isn't returning. The dollar is still dominant, yet fewer actors want to increase exposure. Risk assets are elevated, yet volatility refuses to fully collapse. Individually, each of these can be explained away. Together, they form a pattern that's harder to dismiss. This is the part that makes people uncomfortable. Because patterns don't scream, they whisper. And whispers are easy to ignore until you realize everyone serious is already listening. There's a word for this phase. Not crisis, not collapse. Repositioning. It's when the rules haven't broken yet, but enough people believe they might, that behavior starts changing. And behavior matters more than belief. Right now, nobody is standing at a podium saying, the system is changing. Because saying that creates responsibility. Responsibility to act. Responsibility to explain trade-offs. Responsibility to admit uncertainty. So instead, we get something else. Silence. And silence is not neutral. Silence is often a signal that the conversation is happening somewhere else. This is where most people get lost. They wait for a narrative. They wait for a label, a headline, a crisis name they can Google. But capital doesn't wait for narratives. It moves through spreadsheets, through contracts, through supply agreements and reserve allocations. By the time the story is simple enough to explain, the advantage is gone. So when you hear, there's no breaking news, that doesn't mean nothing is happening. It means whatever is happening doesn't want your attention yet. And historically, those are the moments that matter most. Here's where the shift becomes easier to feel, even if it's still hard to explain. Because when systems are healthy, they don't need constant reassurance. Confidence is quiet. No one has to defend it. No one has to repeat it. No one has to insist that everything is fine. It just works. And that's exactly what feels different right now. Let's start with bonds. Because bonds are supposed to be boring. Long-term government bonds exist for one reason: to price confidence in the future. Not optimism, not growth stories. Just basic trust that time will behave normally. But lately, time itself is being priced strangely. Short-term rates are high, yet long-term conviction refuses to settle. Investors are demanding compensation. Not just for inflation, but for uncertainty about the structure itself. That's unusual, because markets can handle bad news. What they struggle with is unclear rules. Now zoom out. This isn't just about interest rates. It's about where certainty still exists and where it doesn't. Look at how corporations are behaving. Not what they're saying, what they're doing. They're locking in supply years in advance, paying more upfront to reduce future flexibility, accepting lower margins in exchange for predictability. That's not growth behavior. That's defensive positioning. You don't do that unless you're less confident that the market will remain smooth and liquid. Now look at commodities, not prices, structure. More pressure on physical delivery. More stress when supply is delayed. More attention paid to who controls refining, not just extraction. This tells you something important. The system is becoming less tolerant of friction. And when friction matters, paper promises matter less. This is the moment where people usually say, well, this is just post-pandemic normalization. And that explanation sounds reasonable. Until you notice one thing: normalization implies a return to a known baseline. But behavior suggests something else. People aren't preparing for the old normal. They're preparing for a narrower range of outcomes, fewer assumptions, less optionality, more control. Now let's talk about governments, quietly, because governments never move loudly until they have no choice. What they're doing right now isn't dramatic, but it's consistent. Redundant supply chains, strategic stockpiles, domestic capacity that makes no sense financially, unless efficiency is no longer the top priority. That's not politics. That's risk management. Here's the key insight most people miss. When everyone believed the system was stable, efficiency ruled, lowest cost. Just-in-time delivery, maximum leverage. When people stop believing that, they accept inefficiency as the price of survival. And survival is a much stronger motivator than profit. This is why nothing looks broken. Airplanes still fly, markets still open, payments still clear. But the incentives underneath are changing, and incentives shape the future long before outcomes do. Think of it like this. If you believed the road ahead was straight, you'd drive fast. If you weren't sure anymore, you'd slow down. Not because you see danger, but because you no longer trust the map. That's where we are. This isn't fear. Fear is loud. This is caution. And caution spreads quietly among people who don't need to announce it. So when someone says, if something was really wrong, we'd know by now. They're assuming change only happens when it becomes obvious. History says the opposite. The most important shifts happen when things still look normal, but stop behaving that way. And that brings us to the part most people don't want to talk about. Because once you accept that behavior is changing, you have to ask a harder question. Not what is happening, but why trust itself is being repriced. Here's the shift most people don't notice. Trust isn't disappearing, it's becoming selective, and that's far more dangerous than outright panic. In stable systems, trust is broad. You trust the currency, you trust the market, you trust that contracts will behave as expected across time, geography, and institutions. That kind of trust allows abstraction. You don't need to think about who holds what, who controls what, or what happens if something stalls. The system handles it. But when trust narrows, people stop trusting systems and start trusting specific relationships, specific suppliers, specific counterparties, specific jurisdictions. And once that happens, the system starts fragmenting, even if everything still looks connected on the surface. You can see this in how trade is changing, not collapsing, not stopping, just becoming more conditional. More clauses, more guarantees, more what-if language buried deep in contracts. That's not efficiency, that's preparation for friction. Now here's where the dollar conversation gets uncomfortable, and where most commentary becomes dishonest. This is not about the dollar failing. As of now, there is no confirmed evidence that the dollar is losing its role overnight, but there is evidence that fewer actors want to rely on it exclusively, and exclusivity is what made the system smooth. Think about it this way. The dollar doesn't need to collapse for behavior to change. It only needs to stop being the only obvious choice. Once alternatives exist, even imperfect ones, trust spreads out. And when trust spreads out, power becomes harder to concentrate. This is why you're seeing something subtle. Countries aren't rejecting the dollar, they're hedging around it. Corporations aren't abandoning global markets, they're shortening exposure windows. Institutions aren't betting against the system, they're reducing assumptions. None of this creates headlines, because it doesn't feel dramatic, but it accumulates. Here's the part people underestimate. Trust, once narrowed, rarely widens quickly again. Because widening trust requires predictability. Not just good outcomes, but boring ones. And boring has become expensive. Look at how often the rules have changed in just the past few years. Sanctions, not export controls, emergency measures, policy reversals justified as temporary. Each one made sense in isolation. Together, they taught a lesson. The rules are flexible, and flexible rules change incentives. When actors internalize that lesson, they stop optimizing for the best outcome and start optimizing for the least damaging one. That's a profound shift. It lowers growth potential. It increases redundancy. It prioritizes control over scale. And most importantly, it changes where money wants to sit. Money prefers environments where it doesn't have to guess who's in charge, where the rules change slowly, where enforcement is predictable, where exit options are clear. When those conditions weaken globally, capital doesn't flee. It clusters into assets, into regions, into structures that feel less exposed to discretion. That's why this moment feels tense without feeling explosive. Nothing is breaking, but fewer people are willing to lean on assumptions. And systems built on assumptions don't fail loudly. They stiffen. They lose elasticity. They become brittle. And brittle systems don't snap immediately. They hold until pressure shows up somewhere unexpected. Which is why the most important question right now isn't, is something about to collapse? It's this: how much flexibility has already been removed without most people noticing? Systems don't usually fail because of one big shock. They fail because they lose the ability to absorb small ones. Flexibility is what lets a system bend, adjust, and recover without anyone noticing. When flexibility disappears, even minor stress starts leaving marks. In a flexible system, delays are annoying. In a rigid system, delays cascade. A shipment arrives late. A contract clause gets triggered. A hedge fails to offset exposure the way it used to. Nothing dramatic, but the margin for error shrinks. This is the stage where people start saying, why does everything feel harder than it used to? Not broken, just tight. Take liquidity. In theory, markets are liquid. In practice, liquidity depends on willingness. Willingness to quote prices. Willingness to take the other side. Willingness to assume that exit will remain easy. When flexibility disappears, liquidity becomes conditional. It shows up until it's needed most. This is why volatility behaves strangely. Not exploding, not calming down, just lingering. Because participants aren't panicking, they're cautious. And cautious markets don't crash quickly. They grind. Now think about leverage. Leverage only works when outcomes stay within expected ranges. When the range narrows, leverage becomes fragile. So institutions don't announce deleveraging. They just stop adding. They reduce exposure quietly. They shorten time horizons. They demand more collateral. Again, nothing headline worthy, but the system tightens. Here's where this becomes dangerous. Brittle systems look stable right up until they aren't, because they don't show stress gradually. They store it. Pressure accumulates in places no one is watching closely. Secondary markets, less visible currencies, smaller suppliers, peripheral jurisdictions. Not because they matter most, but because they absorb stress first. This is why crises often seem to come out of nowhere. Not because no one could see them, but because the warning signs weren't dramatic enough to attract attention. They looked like inconvenience. There's a reason engineers worry more about rigidity than weakness. Weak systems bend and recover. Rigid systems break suddenly. And right now, the global financial system is becoming more rigid by design, more controls, more safeguards, more redundancies, each one sensible, together constraining. This creates a paradox. The more we try to control outcomes, the less room the system has to adapt. And adaptation is what keeps shocks small. At this stage, people usually ask the wrong question. They ask, what's the trigger going to be? But triggers only matter when a system is already vulnerable. The real issue isn't the spark. It's the dryness of the forest. When flexibility disappears, resilience shifts from the system to the individual actor. Who can exit quickly? Who has optionality? Who doesn't rely on a single pathway working perfectly? That's where advantage moves. Quietly, and this is why money is changing direction without anyone announcing it. Not because people expect disaster, but because they expect less forgiveness, less room for error, less tolerance for surprise, less time to react. When that expectation becomes widespread, the system doesn't collapse. It transforms. And transformations are far harder to spot than explosions. Because by the time something finally breaks, the important shift already happened much earlier, when flexibility disappeared and hardly anyone noticed. Here's the part that confuses most people. If things are getting tighter, if flexibility is disappearing, if trust is becoming selective, why doesn't it feel scary yet? Because fear is a lagging signal. Capital doesn't wait for fear. It waits for probability. And probability changes long before emotions do. Think about how fear actually spreads. It spreads socially. You hear it from friends. You see it in headlines. You feel it when prices move violently and explanations start sounding desperate. But large capital doesn't operate socially. It operates mathematically. When capital moves, it's responding to questions like, what assumptions no longer hold? Which paths no longer feel reversible? Where does error become expensive? None of those questions create panic. They create reallocation. This is why movements look boring at first. Slightly shorter maturities, slightly higher collateral demands, slightly more emphasis on physical control, slightly less trust in intermediaries. Each change is defensible on its own, but together they tell a story about declining tolerance for uncertainty. Here's the key insight. Fear is what happens when uncertainty hits people who aren't prepared. Capital moves when uncertainty hits people who are. By the time fear becomes visible, capital has already found safer ground. This is why the most dangerous phase is not panic, it's calm adjustment. Because calm adjustment feels rational, it feels responsible. It doesn't force anyone to explain themselves. And because it's calm, most people assume nothing important is happening. Look back at history. Major financial shifts didn't start with chaos. They started with preferences changing. What assets felt reliable, what jurisdictions felt predictable, what contracts felt enforceable without political interpretation. Once those preferences shift, money follows quietly. This is also why you rarely get clear warnings. Anyone who moves early has no incentive to announce it. Doing so would raise prices, invite competition, or trigger scrutiny. Silence protects advantage. So when you hear nothing dramatic, that doesn't mean nothing is happening. It often means that people who move first are still moving. Here's where this becomes personal. Most individuals experience fear before they adjust. Capital adjusts before fear appears. That gap is where outcomes diverge, not because one side is smarter, but because one side is structured to act without emotion. This doesn't mean catastrophe is inevitable. It means the margin for forgiveness is shrinking. And when forgiveness shrinks, mistakes become more expensive for companies, for governments, for households. Which brings us to the final uncomfortable realization. The question isn't whether something bad is coming. The question is whether the system still absorbs mistakes quietly or starts passing them through. Because once errors stop being absorbed, they become visible, and visibility is when fear finally arrives. But by then, the direction of capital has already been set. Here's the most unsettling part of all this. Nothing is wrong yet. No emergency measures, no market freeze, no visible breakdown. And that's exactly why this phase is dangerous. Because systems don't warn you when they're losing tolerance. They only warn you when tolerance is already gone. At this stage, everyone can still explain everything. Higher rates, temporary adjustment. Supply constraints, geopolitics, market volatility, just uncertainty. All reasonable answers, all incomplete. What's missing from those explanations is a simple realization. The system isn't failing. It's becoming less forgiving. And forgiveness is what made the last few decades feel easy. Think about how many things used to just work. Credit was always available. Liquidity always showed up. Supply chains always rerouted. Mistakes were smoothed over by time. That environment trained people to assume recoverability. That assumption is quietly weakening. When recoverability disappears, behavior changes even if outcomes don't. People stop asking, what's the upside? And start asking, what happens if this doesn't work? That shift alone reshapes the future. This is why capital is moving without signaling fear. It's not trying to escape. It's trying to avoid being trapped. Trapped in illiquidity. Trapped in rigid systems. Trapped in assumptions that no longer self-correct. And this is where most observers misread the moment. They look for collapse, but collapse is loud. What's happening now is quiet sorting. Who can adapt quickly? Who relies on smooth functioning? Who can absorb friction? And who can't? Those distinctions don't make headlines. They decide outcomes. If you zoom out far enough, this moment doesn't look dramatic. It looks transitional. And transitions are invisible until they're behind you. So here's the question to sit with. Not, is a crisis coming? But what happens when mistakes stop being absorbed and start being passed through? Because when that happens, the world doesn't end. It just feels less generous, less flexible, less patient, less forgiving of error. That's when small decisions start to matter more. Timing matters more. Structure matters more. Optionality matters more. Not because anyone planned it that way, but because the system no longer cushions outcomes. And here's the final thought. The most important shifts in history were never obvious in the moment. They felt like background noise, like subtle discomfort, like things taking longer than they used to, like explanations that technically made sense but didn't feel satisfying anymore. We're living in one of those moments now. There's no breaking news, no single event to point to, just a quiet sense that the old assumptions aren't carrying as much weight. By the time that realization becomes widespread, the direction will already be locked in. The only open question is, who noticed early enough to adjust before adjustment became unavoidable? This story isn't over, it's barely begun.